Hello everyone. So in this video, I would like to discuss with you the financial statement of firms. And instead of looking through the slide or definition, I will show you how financial statement evolve and how people can use those statements to keep track of the performance of firms. So let's start with my assumption. Like I have $100,000 and I want to create my own business. So at the very beginning, my business, the asset of my business is cash, right? $100,000 cash. So 100,000, okay, $100,000. Yep. Now it is the asset of my company. Here's the balance sheet. The two part. One is the asset, and the other is equity and liability. The idea is that here's a firm asset, those who can touch, those you can touch and smell it, And on the other hand, the equity and liability record the source of the money that finance the assets. So in my situation, okay, my company have 100,000 cash. Where the cash come from, So like I said, it is my own money. It is my own money. So it is my savings, right? In terms of accounting, the term for the owner's saving or the owner's money is equity. And over here, my equity is 100,000. Yep, that's it. Give me a second. Yep, 100,000. So you see that the asset side and the equity and liability side are always equal. So you see here the total asset 100,000 and total liability and equity here is 100,000. So that is why we call it balance. Okay. Now the next day I decided that I need to buy a computer, for my work, and the computer is $2,000. I pay by cash. In this case, the cash is no longer 100,000, but only 98,000, right? Yep. And the computer is 2,000. Yep. So you see, instead of saying computer, I mean the general term for that is equipment. Yep. So equipment is 2,000. Summing up, everything is still 100,000. Yep, it's still balanced, right? Now the next day, I decided to buy like a 1,000 book. Yep. So the value for that is $50 a piece. So 1,000 multiplied by 50, we're talking about like the total cost of 50,000, and I pay by cash. So if I pay by cash 50,000, of course the cash will drop by 50,000, right? So the cash only have 48,000, and the book will be 50,000. So the term for the book on the balance sheet, is inventory. Yep. So you see here now the balance sheet is 48 cash, 50 inventory, 2 equipment. So the total is still 100,000. So look at the balance sheet. I know right away the distribution or the composition of my assets. So you can see that the total current, and then as you see in the book, there is some different classification of asset. The short term is called current asset. The long term is called like a long term asset. So over here we have the cash and inventory of 98,000, and they are all short term asset, and therefore the total short term asset or the total current asset is 98,000. Yep. Okay. Sorry, I messed up with the Excel a little bit. So the total asset equal to the total current asset plus the total long-term asset or total equipment is 98 plus 2 is 100,000. So you see that the balance sheet is balanced. Okay. Now I figured out that my cash is only like 48. So it may not, in the long term, it may not be good enough. So I thinking like, okay, let's buy book on credit instead of paying cash. right? So if I buy book, say 10,000 more on credit, I haven't paid the supplier yet. So the book now, instead of 50,000, it will become 60,000. Yep. The total current asset become 108, equipment 2,000. So total asset now is 110. Yep. Look at the equity and liability. The total is 100. So I need to adjust it for the 10,000 I borrow from the supplier, and the name for that is account payable. What I have to pay in the future. So it is 10,000. 1, 2, 3. Yeah. So now it balanced. So you see that the equity and liability show you the source to finance for the asset, right? Yep. And the last transaction I want to mention is, okay, I want to then I borrow from a bank. Yep. For say 2 years. So 2 years mean long term, right? So I borrow the bank long term, and I borrow like 25,000. So the total equity and liability here is 1, 2, 3 things add up, it is 35. Now we have to adjust the 25,000 somewhere on the assets, and assuming that when I borrow, I keep everything right now in cash. So the cash at the beginning is 48. Now I have to add 25 into it. So 48 plus 25, 73. Yeah. Now the cash is 73,000. So you see the total asset and the total liability and equity now is the same as 135,000. So I hope that through this video you can understand better the balance. Okay, so after a while, I want to see what is the profitability of my business. You can see that if I look at the balance sheet right here, there is nothing show me about the net income or the profitability. So it is when the second financial statement, the name is income statement, come into play. So the income statement, when keeping track of the business from the profitability perspective, it will show you how much is your sale, how much is your cost, and the bottom line is what is the net income. So I figured out that the revenue for my company is 20,000 from the beginning up to this point. I selling like how much 20 I mean few hundred book or so, and multiply the number of book I sold with the cost. I know that the total cost of the book I already sold is 12,000. Yep. So the term for that is the cost of goods sold. How much you pay to acquire the good you sell. So the cost is 12, and you sell it for 20,000. Pretty good, right? Okay. And the difference when you subtract the revenue and from cost of goods sold, you have one entry called the gross profit. So over here, when you take 20 and minus 12,000, the gross profit in this case is 8,000, right? Yep, 8,000 gross profit. Okay, but guess what? I still have to pay for a lot of things, right? Like the general and administrative expense, I have to pay for myself, because I'm the owner of the firm. The firm have to pay me. So assuming that at this early stage, I don't want to take anything from the firm. I want to contribute as much money as I could to the firm, so I don't take any money. So the administrative expense is zero. However, there are something like the marketing expense. I have to send the flyer here or there, so the total cost for the marketing is supposed to be like $1,000. Yep. So total operating expense, that few thing over here, it could be include some other thing, right? But with me, the total operating expense is only 1,000. Yep. It equal to administrative expense plus marketing expense plus some kind of depreciation. So total operating expense is 1,000. Now, if you take the gross profit, yep, and minus the total operating expense, okay, what you receive is 7,000, right? 8 minus 1 is 7,000, and the name for that is operating income. So operating income here is 7,000. Yep. And then don't forget that we have a long-term debt of 25,000 and we have to pay interest on it. And assuming that the interest rate is quite low, so you only have to pay like say 500. Let's put it say 1,000. Yep. So the operating income is 7,000. You have to pay 1,000 interest expense. So the income eventually you receive is 6,000, right? Yep. It is income before tax. We have to pay tax. That's it. So let's assume that the tax rate is a 20%. So over here you take income before tax multiplied by 20%. So tax is 1,200. And after subtracting the tax, yes, we come up with our money. It is 6,000 minus tax equal to 4,800. So it is a net income, the bottom line of our performance over the first quarter in operation. Yep. So here is the most two important: balance sheets and income statement. Yep. Thank you.